There is growing evidence that this mass migration to Tennessee, to Nashville, is starting to accelerate. Now, before I show you some Nashville data that illustrates that this is picking up steam, I want to talk about why we're even seeing an inbound migration. Why would it be accelerating this year?
Washington State is set to impose a 10% tax on millionaires.
I think the claims that millionaires are going to leave our state are like super overblown, and if the ones that leave, like, bye.
Now, she's not the only one, and Washington isn't the only state going after the wealthy to close the gap in their budgets. Mayor Mamdani of New York is doing the same thing, and California is proposing a wealth tax. These are causing people to make decisions that they've held off on making for years. And Nashville is a direct beneficiary of this movement. Peter Thiel did a whole analysis on Joe Rogan one time, and his conclusion was Nashville or Miami.
That leaves Nashville, Tennessee, or Miami, South Florida. And those would be my two top choices.
And he's not the only one coming to these conclusions. It's interesting to me that Howard Schultz, the founder of Starbucks, announced a move to Miami, and Starbucks itself is creating a regional headquarters in Nashville.
Starbucks founder Howard Schultz announced he and his family have moved to Florida just one day after the millionaire's tax passed the House.
Starbucks, a company synonymous with Seattle, may be looking to change its brew. The company says it'll open a new headquarters in Nashville and transition jobs to Tennessee.
Now, if wealthy buyers are leaving California, New York, Illinois, Washington, and they're choosing Tennessee, what would that look like in pending contract data? Well, for one, we would see more demand than we saw last year, and that's exactly what we're seeing. We're now up 12.7% compared to last year at this time. But more importantly, it would be K-shaped. The top would be exploding, the bottom would be much more modest as out-of-towners continue to drive up prices and make things more unaffordable for the locals. If we look at demand, every price band is positive, but the shape is everything. The bottom three price bands are all under 9% year-over-year growth, while the top three price bands are all over 25% year-over-year growth. And look at the 2 million plus price band. It's up 53.8%. Now, there are two counties that I think have raised my eyebrows this week. The first is Williamson, where you would expect. It's where the wealth has always traditionally gone to and been. It's the first pick in the 9 counties, typically from out-of-towners. They hone in on Williamson. But Sumner is also catching my eye. Both are up 22.6% year over year in demand. And inside both, we see the same K shape. Lower price bands are flat to negative. Top tier are absolutely surging. With Williamson County, $2 million homes are now up 67% on contracts from a year ago. It's pretty wild. Now, the wealth migration seems to be real. The question is whether it's the only thing happening. Is there a move-up market that's also unlocking? And here's where things get very interesting, in my opinion, because this could signal demand for the rest of the year. Now, if we strip out the new construction and look only at existing homes, the resale market, the locals, existing home, move up, sellers, it's up 14.4% year over year. That's locals that could be trading up. What this tells me is that this is the most important takeaway in this video. We have inbound migration filling in the top, and we have the move up cycle that's finally starting to unlock on the resale side. But again, it's in that K-shaped format. Keep in mind, at the beginning of this year, I saw these trends starting to shift, but then we had the massive snowstorm, which shut down demand in February, which showed up in March sales. So why is the bottom of the market still slow? Existing homes under 300K are only up 5.8% year over year in demand. That's half the metro pace. That's the entry-level Nashville buyer. Why? And here's the crazy part. If you include condos and townhouses, this segment under 300,000, it's grown 30% year over year, and yet it has some of the slowest demand growth of any price band. The bottleneck, in my opinion, is the math. rent versus owning. A $500,000 median Nashville home today at today's mortgage rates of 6.25%, it's about $2,900 a month all in. Now, average rent on a single family house per Zillow is $2,500 a month, and it's actually down $71 year over year. So rent is roughly $500 to $1,000 less, depending on how much you put down. That's much, much cheaper than a mortgage for the same kind of house. And that rational choice for a young Nashville household is to keep renting in situations like this, where it's basically unaffordable. Now, it's true that rates have come down. A year ago, it was 6.75%. The same payment is about $130 a month lower this year. But rent fell too. So the rent versus own spread barely budged. What about supply and prices? Two quick things to watch on the other side of this market. One, active listing growth is slowing. Supply growth has been cut by more than half this year, from 17% year over year in January down to 8.2% today. If that pace holds, we could see flat to negative active listings growth by the end of June. That would mean the supply tailwind we've enjoyed for 2 years is completely gone, exactly as demand is grinding higher. This isn't really that great. In fact, it's a little bit disappointing. I was hoping we would get 10,000 single-family homes this year. Now I'm wondering if we'll even break last year's record at 9,355 hit in July. We also have price cuts approaching 35%. The share of active listings carrying a price cut right now is 34.4%, and it's climbing. Once this crosses 35%, which it's about to, history says soft to negative prices for the rest of the year. Keep in mind, when more than 1/3 of agents are getting their sellers to cut their price, typically that signals that the market pricing has shifted down, and it's very possible, in fact, it's likely we'll see that this year. So even with stronger demand, we're also seeing soft to negative prices this year. And that's the setup. So here's the picture. There is a real wealth migration, and it is hitting the top of the Nashville market hard. We're also seeing a lot of the wealth that is in Nashville starting to trade up. Existing home contracts, they're up 14.4%, which means the move-up market is unlocking too. That does mean that we could see demand grind higher for the rest of the year. Now, the catch is the lower price bands are constrained by affordability and cheap rent. Until rates drop dramatically, incomes increase dramatically, or prices start to fall in a material way, that part of the market is just going to be much slower than the rest. We are at an inflection point. Demand has likely troughed, and active listings may have peaked for this real estate cycle. Personally, I hope that's not the case, but it may be. And prices probably will be soft for the rest of the year. They may even be negative. In fact, it's very possible they'll be negative. Rates, oil, geopolitics, there's so much noise out there that can change the housing market in an instant. What's the part of this that you're seeing on the ground that the data isn't showing? Especially if you're in Sumner or Williamson, if you're an agent taking calls from out-of-state buyers, what state are people moving from? And if you're an entry-level buyer, is it the rent versus mortgage math that keeps you from purchasing something today? As always, thank you so much for watching. I hope you guys have a great rest of your day, and I look forward to seeing you next Saturday. Thanks a lot.